Okay, well, I'm glad that everyone was able to make it today, and we've got a really interesting topic we'll be discussing. We're going to go into quite a bit of detail here about the subject of bond investing. And this is something that I'm going to give a simple overview, but I'm also going to teach some things that a lot of people don't really understand about bond investing, some of the more advanced things. So let's go through the basics. Probably the number one relationship that's the most important to understand about bond investing is the relationship between interest rates and bond prices. As the interest rates increase, your bond prices decrease. And we'll talk about why that happens, and we'll talk about the implications of that in the next few slides. Now let's talk about the history of bonds. I just love this history. This is actually an interesting history. The first bonds were issued by the Bank of England in 1694. And it actually, the history of it is they were issued in order to assist with the war against Napoleon and France. So they were used to finance war. And this is a very interesting picture. What you've got here is the actual horse that was Napoleon's horse, one of his horses. He had several, but this is in a museum in France. The horse's name is Vizier. And you can actually see on the horse the little N for Napoleon and the brand, which it's fascinating that this horse is still in a museum. But the point of the history is that it originated out of wars, and that was actually what was part of what the history of it is. In the United Kingdom, bond gilts are a UK bond. They were actually first kind of used by Nathan Rothschild. He was a European Jewish financier, and we've all heard of the Rothschild family, but this is actually how part of the way that he made money was he helped to ensure Britain's preeminence by these bonds. And it's an interesting story. This is what you're looking at here is an example of an early issue. And in 1815, when the combined forces of Britain and Prussia, when they defeated Napoleon's army at the Battle of Waterloo, when this happened, it wasn't like today where all of it's on the news and everybody knew the result of the battle. And there's a couple of stories about this that were quite interesting. The first one is that it might have been a writer that very quickly rode the news to London on the fact that the UK had won, that Britain had won, not the UK, Britain had won. And in fact, another version of the story was it was actually carried by a pigeon, a carrier pigeon. Now, I mean, some of it might be true, some of it might be just a legend. But as a result of having the information ahead of time, Rothschild was able to actually go in and buy up a lot of bonds with his friends. So people didn't know what the result of it was. And he kind of gave the impression to people that it was a loss, when in fact it was a victory. So when people thought it was a loss on the trading floor, the value of those bonds went down. Everybody wanted to sell the bond, and he was able to, with his friends, buy all of these bonds, and he made a tremendous amount of money on that deal. So there's a lot of reasons that people buy bonds, used to finance debt, finance capital investments, and of course, wars. They're also used for financing wars. There's different categories of bonds. The first category is, of course, the government bonds. If you look at the United Kingdom, they have gilts. These are very popular bonds. If you look at the United States, we have our treasury bonds. We've got a lot of different categories. And then there's corporate bonds. And in general, a corporate income bond pays a lot more than a government bond, because by definition, a government bond has zero default risk, because by definition, the government always has the ability to pay the bond since they can create more money. Now we'll go through just a few things in the vocabulary that's real important to understand with bonds, and then we'll talk about how this all relates. So you'll hear sometimes the term bonds, sometimes you'll hear the term notes. And when you hear somebody talking about a note, that usually is referring to a debt obligation that might be 5 to 10 years. There's kind of an exception with mortgage notes, because mortgage notes can be 20 or 30 years. But in the context of bonds versus notes, bonds are longer term normally. And the term of a bond, it can range. It can actually range widely on how long they are. Some of them might be as short as 5 to 30 years, and there's some that you can find that could be over 100 years. For example, from history, the consul bonds, the perpetuities that were issued to finance the war with Napoleon, those bonds had no end date. They were supposed to forever pay that. And actually, they did make payments for over 100 years. Now, the important one about bonds, and the one that hurts people when they don't understand about bonds, is the yield. And there's a very important relationship that most new investors don't really understand. Most new investors, they understand how it works with a bond pays interest. They get that part. But what hurts them, what confuses them, is when you start talking about yield and duration. So basically, there's a market price for bonds, and this market price, it fluctuates over time. So let's talk about how that works with duration. This is an illustration that shows that if the interest rates move 1%, if there's a 1 percentage point move in interest rates, the longer the term of the bond, the more the price of the bond is affected. So let's say you have a bond that is a 1-year bond and there's a 1% move in interest rates. Well, that's not going to change the price very much. An interest rate move on a short-term bond that's only a 1% interest rate move, it might move the price perhaps 1%. But if you talk about, say, a 5-year or a 6-year bond, if there's a bond that you own, imagine you buy a 5-year bond, and imagine that the interest rates increase 1%. Well, your bond is going to decrease in price by approximately 5%. So if you used to have a £100,000 bond and the interest rates moved 1%, the market value is now £95,000. If you're on a 20 or a 30-year bond, it's even more affected. So what hurts people is they will sometimes buy bonds because they think a bond is safe. They're advertised as being safer than a stock. But if you buy a long-term bond that's like a 20 or a 30-year bond, if you buy a 20-year bond that's a government bond of some sort, and the interest rate increases 1%, you can have a 20% loss of capital. So if you bought a bond that has 100,000 value and it's a 20-year bond and the interest rate increases 1%, the value of that bond now is 80,000 in the market. And it's vice versa. If the interest rates were to decrease, your bond could go from being worth 100,000 to now it's worth approximately 120,000. But the point is, with bonds, if you get longer term bonds, you're much more susceptible to interest rate swings. And that's something